Hi guys, welcome to SavvyMoneyShow. Me, your host Sean. Now, I've done a few videos about ETFs in the past, so I'm doing one over QYLD. I've spoke about it before. It's a covered call ETF. Now, the thing is, it gives a 12% return. It's a monthly dividend, and the expense rate is 0.6%. Of course, in the UK, you have taxes to think about as well. Now, how does it work? Well, what they do is they will buy the stocks and they will sell a covered call. It's as simple as that, and the money they bring in from that, they pay the dividend with. It's not too complicated. If a call gets exercised, it means they've been profitable on their investment. So it's win-win. But what a lot of people are talking about, and I have actually said you could actually do both of these if you want, is sacrifice some growth for some protection. And both the QYLD and NUSI focus on the QQQ, and difference with NUSI is it takes the money it gets from the covered calls and puts some of it into puts. Now, to protect the share price. Now, if the call does get exercised, instead of giving the shares, it pays the cost of the shares instead, so it keeps the shares always on the balance sheet. That's the difference. Now, this gives an 8% return on average, although it says 7.5%. It's 0.68% expense ratio. But some people prefer it, especially nowadays, because it has the put option as well. So they're willing to sacrifice some of the dividend in case of something like a market crash or correction. Anyway, let's move on to some stocks. Don't forget to hit that lovely like button, and don't forget the sexy subscribe button. A lot sexier than me, just ask the wife. And if you want to be a hero, hit the bell notification. You'll be notified when a new video gets uploaded. And why not check out the links in the description below. If you're looking for a free trading platform, you get a free share worth up to $200, depending on the platform you use if you deposit a small amount. Now, it's an MJ stock, an OTC, and is basically at half price, and its market cap is under enterprise value, CCHWF, Columbia Care, and I think is going to have huge growth over the next 3 years. The price to book is 2, and it has opened a dispensary in Missouri. I do think it'll do well. Now, we have a stock I spoke about before, VXRT. Now, again, I think if you hold it for the next few years, we'll have massive growth. Now, it's one of these that they are doing a tablet for the SARS-CoV vaccine. Now, I think if you look at the way Merck has gone up, and to tell the truth, Merck needs a lot of money, to get that to move because of the share structure. And you think it was $25, this was not long ago, then I think this could really do well. It's fundamentals maybe not so well, but I think it will have plenty of growth. Remember, it's a biotech stock. Anyway, now Val, I spoke about this a while ago. It's an iron ore company, and it's talking about separating its metal business, its base metal business, and merging it with the assets of another. Now, it has PE of 4.5, and when you consider that it's trading at 70% off, it's 30% off the all-time high. Not all-time, sorry, the 52-week high. Its market cap is 73 billion versus 100 billion. Forward PE is slightly better than the trailing PE, but not much. Price to sales is 0.25. Price to book is 0.35. I think it's worth dipping your toe in. It gives a 19% dividend. I mean, what a dividend to hold. Of course, that's not guaranteed, but yeah, you can see how each time dividend comes up, it jumps up. But this time especially, from dividend chasers. Now, I would hold it long term, especially now with what's going on. You're getting materials being in a short supply. I'll see you in the next video. If you found any of my videos helpful and you want to help me make more, you can support me by buying me a coffee. The link is in the description below.